Good evening and welcome to our Cows and Chaos Feed, Forage, and Management Strategies webinar series. My name is Dean Dick. I'm the Farm Management Specialist at the Ag Info Center with Alberta Agriculture and Forestry. I'm pleased to be the host for the webinar this evening. A couple of housekeeping items for those of you online here. First of all, this webinar is being recorded and you'll be able to listen to it if you missed a few things. We'll give you a link by email tomorrow, so you can just click on at your convenience and listen. Secondly, questions. The best way to ask questions is that you should have a question box in your GoToWebinar control panel. So type in your questions and we will handle them after the presentations are done. So with that, tonight our topic is economics of forage production and some cattle market outlook. So with us tonight we have Ted Nibourg, our farm management specialist at the Ag Info Center, and Jason Wood, our provincial livestock market analyst. So I'm going to turn it over to Ted to do the first part of the presentation. Ted.
Thank you, Dean. Well, welcome everybody. I'm coming to you from just outside of Stettler, blustery Stettler tonight. It's raining like the dickens, and I guess it's a good night to be having a presentation. What I'll be talking about tonight initially would be we're going to be discussing standing hay pricing and hay share arrangements. Now, the standing hay price is a function of yield and price, the price in the bale after harvest, minus the cost for putting it up. All-in harvesting costs, which includes cutting, baling, raking, and stacking, and there's a certain labor component to that. Those costs are about $22 a bale. That's a 1,200 pound bale for low-cost producers. And that'll be about 3 bales to the acre, about 1.8 tons to the acre production. For the high cost producers, it'll be about $38 a bale. And on average, it's about $29 a bale. It will vary with production. The costs increase with lower production, and that's primarily a function of the cutting costs, because if you're only baling, say, 1 ton to the acre, you're still going around that field, whether you're doing 1 ton or 2 tons. So it just increases the per bale cost when the yield is down. I'm going to give you one scenario. The first scenario I'm going to give you is 1.8 tons to the acre, which 1,200 pound bales results in 3 bales to the acre. I'm going to use 6 cents a pound, and I think this year that's probably going to be the low end of where the hay is going to settle out. So that gives us $72 a bale. And if we take the all-in harvesting costs on average of $29 a bale, that will leave a standing hay price of about $43 a bale. When we work on a share basis, 60% of that accrues to the landowner and 40% goes to the tenant. The tenant has lower costs. The harvesting cost, his $29 a bale, is what his costs are. And when we have the commodity, the hay commodity accrues to the landowners. That's why we have the 60-40 split. Scenario 2 is reduced production, 1.5 tons to the acre, which results in about 2.5 bales to the acre. Again, it's 6 cents a pound. It's still worth $72 a bale. The harvesting costs have increased because, as I said earlier, you're spending more time going around the field with your hay bine, and so that increases the cost. So that leaves a standing hay price of about $40 a bale, and that share gets closer to an even split. In the past, when we had some average hay prices, say that 4 to 5 cents a pound, we often had the 50-50 split because the share between the landowner and the tenant were roughly the same. So we had a 50-50 split. And in the last couple of years, that share has definitely shifted towards the landowner. They're the ones with the high price commodity. The tenant's share, the cost of putting up the hay has been relatively stable, although it has creeped up. Scenario 3, we're going to go with that 1.5 tons an acre again. 1,200 pound bales, 2.5 bales to the acre. We're going to use 8 cents a pound, which gives us $96 a bale. Again, the all-in harvesting costs are $32 a bale. So that leaves a standing hay price of $64 a bale. In that case, the share turns out to be 2/3 for the landowner and 1/3 to the tenant. When we take those prices into the hay prices into the cow-calf feeding break-evens, we see where we hit where we kind of hit the ceiling. And I mentioned that in scenario 3, I used 8 cents, and I think that's going to be roughly about the 8 cent. 8 cents is going to be probably the ceiling that we're going to hit with cattle hay. We have basically 3 different markets in this province for hay. One is the cattle market. That's definitely the largest one and predominant one. And then we have a market for dairy hay. They're very selective, and we also have a market for horse hay. And I think with dairy and horse, the price elasticity is actually quite low. They don't have alternative feeds to go to, unlike the cow-calf operator. Cow-calf operator can use salvage crop, can use silage, can use hay and straw, or barley and straw, grain and straw, and so they have a lot more options in terms of their feeding. Some of the things that come into play, the Stats Canada January 1st numbers, we saw a reduction in cows of about 1.4%, and heifers, bred heifers, about 2.3%. So basically, our cow herd is not being replenished if our bred heifer numbers are going down. Margins have been tight for cow-calf operators due primarily to the feed costs, and we'll go into some of that a little bit later. We are seeing a potential for downsizing or liquidation. We keep getting reports at the Ag Info Center quite often that people are liquidating the herds or drastically reducing the size of their herds. So let's go into feed costs. I ran some rations through our Cow Bites program for some 1,400 pound cows, and I used $5 a bushel barley and $50 a ton straw. And that came out to about $2.20 a day per head in the wintertime. And that was just the feed cost. That wasn't the yardage or anything like that. It was just the feed cost. When I ran through the same rations using 8 cents a pound straight grass hay, it gave me a price of $2.75 per head per day. We did get reports of hay in that 10 cents a pound range for cow-calf operations. I put that into the Cow Bites program, and it jumped up to $3.40 per head per day. And then there was the odd case where there was some hay selling for 12 cents a pound, and boy, that popped it right up to $4.10 per head per day. I took those rations and I put it into our Rancher's Return program. And I used, as an example, I used a 100 head cow herd, weaning about 85%. I think with some of the stressors in terms of feeding in the winter that we had, that February was kind of cold. That might be a little bit on the high side, but I think it's fairly conservative. I took some 650 pound steer calves, averaging $210 a hundredweight. And then I took some same about 6-weight heifer calves, averaging $190 a hundredweight. When I put that barley straw ration into the Rancher's Return program, it gave me that ration resulted in about 53% of the total production cost. And it gave me a gross margin on that 100 cow herd of $13,000, $13,250 for gross margin. When I put that 8 cent a pound hay ration in, it jumped up our production costs up to 58% of total production costs. And that resulted in a negative $250 gross margin, or basically break even. And so that's why I felt that the 8 cent a pound was going to be the ceiling in terms of economical hay pricing this year. I also ran the 10 cent a pound ration through through rancher's return and came up with a production cost increase of another 5%, up to 63.5% total production cost. And that resulted in a negative $15,131 gross margin. So a loss of $15,000. Person would have to sell about 12 cows, 12 of the Cull Cows just to cover that cost. And then it's no surprise the 12-cent a pound hay ration increased total production costs up to 68%. And we've always said that the feed costs in any operation, cow-calf operation, is the majority of the cost, production costs, and it increases as the price of that hay goes up. And that person would have lost about 30 grand, or he'd have to sell about 25 cows just to cover that. When I ran through some of those numbers through break-evens for the 2019 calf crop, the barley straw ration, the break-even calf price averaging both heifers and steers, of course, there's usually about a 10 to 20% difference between heifers and steers. The average I came out with the break-even would have been about $176 a hundredweight, which I think is going to be pretty good if there's going to be some profit if that's the break-even price. With the 8-cent a pound ration, hay ration, the break-even was $202 a hundredweight, and I think that's doable this year. And I think once we get into Jason's presentation, we'll see if that's the issue. I think he'll going to give us some firmer numbers in terms of that. At 10 cents a pound, $229 a hundredweight, and that's, you got to remember, that's an average between heifers and steers. And if there's a bigger differential between heifers than steers, that might be a little bit tough. Then we get into the 12-cent a pound ration, $258 a hundredweight. I guess we're going to have a crystal ball, and that's what Jason's going to give us, and that's going to be the segue into Jason's presentation. Dean?
Good, thanks, Ted. I am now going to let Jason do his, move over to Jason for his presentation. So,
all right.
There we go, good.
Screen's up there?
Yeah, everything's good, go ahead.
Perfect, all right, thank you, Ted. Thanks to everybody for joining us here tonight. So I'm just gonna go through and give a short cattle market update here. Oops. Let's see. There we go. All right, so I'm just going to talk about Fed supplies first off here, just both in North America, and then I'm going to touch a little bit on Australia because it has part of the story here as well. Then I'm going to go into markets. I'm going to talk about prices, see what's going on there. Just going to give a short note here on basis levels. I'm not going to show any basis charts, but I just want to note that they're trending near historical seasonal averages right now. Earlier in the year, we did have on the Fed side for slaughter cattle, the basis was quite weak. It was down, $22 under, and that was quite a bit lower than what we would typically see at that time of year. Since then, through April, it has strengthened back up, and now it's trending in line with the historical average. So right now we're at about $2 over last week. So that's where that Fed basis is. And then we've also seen the feeder cattle basis come back in line with the historical average. It was a little bit high here, strong over the last 4 or 5 weeks, but it's come back down into historical averages. And then on the cow side, I'll talk more about the sort of what that price, cash price spread is between us and the US later on. But we've seen our premium over the US market on Cull Cows really come back down, and we've I guess to a certain extent lost most of that premium, where we're now trading pretty much on par with the US market on the cull side. Go through some cattle movements, some feeding margins, and then slaughter and exports. And then just further to what Ted was talking there, I'll do some charts here I have on the current feed market. And then I've got some winter cow feeding cost estimates that are based on to go through some of the data that's collected here. And then I've got a chart on the fall price outlook. So that's kind of, I guess, the crystal ball, and we'll see whether or not how true that becomes. So on the Fed supply here, just on US Fed supplies, you can see here that red line is for the 2018-19 marketing year. For July, the estimates or the report comes out tomorrow afternoon out of the USDA, but right now estimates are to see that cattle on feed will be about 11.5 million head on feed in the U.S. That will be about 2% above July of last year, and that's about 9% above that 5-year average, which is the gray bars there on the chart. That number is historically high for July. I don't know if that's the highest number that's ever been on July for the U.S., but it is historically high. Placements are expected to be about 2 to 4% lower year over year for June placements in the U.S., and that reduction in placements really feeds into the good pasture conditions that they're seeing in the U.S. right now, and then also the higher cost of corn that feed yards are having to deal with. So that's kind of pushed those placement numbers down. There was some stats, and I'm pretty sure, I'd have to double check, but it was well over 90% of U.S. cattle were in areas with good to excellent pasture conditions this year. So a lot of those cattle have been kept on grass rather than going into the feedlot. So we probably will see more feedlot placements as we come into the fall into the U.S. Marketings were down 3% for June in the U.S., and that just has to do with more or less one less marketing day and then a few less head going through per day on average. Some concerns for the U.S. market. There's some concerns about local beef demand, and that just translates back to some concerns about the overall U.S. economy. And then also we've got a lot of cheaper pork and chicken production that's also competing with the higher priced beef market. And then the strength of exports has also been a concern. Beef exports haven't really taken off the way that I think some of the market had hoped, and there's really is some concern for the second half of 2019 in the U.S. The other thing that'll be released tomorrow will be the July 1st cattle numbers for the U.S., and that's expected to show those numbers not really down, but pretty much on par with the previous year. So, and that's just some of those cows being kept back for the good grass conditions. So I just wanted to touch a little bit on Australia. This is their cattle on feed numbers. This is the latest data that is available for Q1 2019, which had about 1.1 million head on feed, and that's up 14% year over year. The ongoing drought conditions there have really pushed a lot of those cattle into feedlots. There's a lot of feed supply issues, and then the other issue is water availability. Trying to get water for the cattle has become a big issue there. Overall, with the increase in cow slaughter due to drought, they're expecting their beef cattle numbers in Australia to be down 8% to about 25.2 million head for July 30th or their July 1st date. And those numbers also include those 500,000 to 700,000 head that were estimated to be lost in the floods earlier this year. And as we continue to see those cull cow numbers really stay strong, culling numbers stay strong there, we're going to see their beef exports eventually. They've already started to decrease, but we'll start to see more and more of those reduction in beef exports, especially if conditions there change and you start to see expansion. And the opportunity there is then for for Canada to step into some of those markets that Australia is a definite competitor in, such as Japan and even the US. And with Australia's beef exports reducing, we've also seen the imports of beef from Australia into Canada reduce as well. So right now, female slaughter in Australia is running at about 52% on average for the year, which shows that they're definitely in a contraction state there. In Alberta here, our cattle on feed numbers are we're just a hair over 900,000 head on feed for July 1st. That's the 14th consecutive month that cattle on feed has been above year-ago levels. And this is the largest July number since 2001. So we've got a lot of cattle on feed here as well. Placements were down about 21% in June, and marketings were down about 6%. And we just saw some of those cattle being held longer on feed as opposed to letting them go as a way to try and get a little bit of leverage in the market. Overall, we've seen heifer placements this year averaging about 35% in Alberta feed yards, and that's down a little bit. We did see a big drop in heifer placements in June, and some of the feeling is that we also saw an increase in live exports to the US, so maybe a lot of those heifer feeders went down to the US, but there's no definite answer on that one. And then we're also seeing more dairy steers being placed on feed. So that's going to affect down the road. That's going to affect when some of those cattle are finished and ready for slaughter. So if we look at some of the markets here, you can see on the steer calves here in Alberta for a 550-pound steer calf, last week we were at $209.50 a hundredweight. That's about $1,150 a head. Year to date, prices have been, fairly steady, give or take. The last 5-6 weeks here, we've seen prices come down, but year to date, we've been averaging about $223 a hundredweight. That's only down about 1% from 2018. And we're down about 9% from the 5-year average on that one. Part of the reason that we've seen calf prices weaker over the last 5 to 6 weeks here is just those higher feed costs against for placing those calves in feedlots. So we've seen that feed costs go up, which has pushed that price down. The other factor that's kind of playing into there is there's a lot of talk about the strengthening Canadian dollar and the potential for it to hit 80 cents or even a bit higher in the second half of 2019. And that 80-cent dollar potential is playing into this as well. On yearling steers last week, we were averaging 173 a hundredweight. That's about $14.70 per head for an 850-pound yearling. Year to date, we are averaging about 180 per hundredweight. That's up about 2% from a year ago, but still we're about 7% below the 5-year average on a year-to-date basis. Feeder steers, typically we would see them strengthen on average about 2 to 3% from July. That's sort of that seasonal average increase from July into September. And then we'll see them soften into the winter months after that. So, with that seasonal factor there, and then also looking at where the feeder or where the futures market is, taking an average basis level, you can see those black triangles there are sort of where those feeder numbers are at for fall delivery. So we've got them averaging there in the low to mid 180s through the rest of the year right now. Of course, there's, obviously the basis has potential to move in there, which can change that. Over the last 6 weeks, we've seen that basis levels, I talked about that, were quite strong. Now they've come back in line with the, hovering around that 0 mark. So we're still a bit stronger than we are above the 5-year average on the yearling basis, but they have come back down, which has also pulled that price back down. On slaughter steers, last week we were just over 144 a hundredweight. So that's about $19.50 a head for a 1350-pound finished steer. Year to date, we've been averaging about 154 a hundredweight. That's down about 2.5%. Sorry, it's up about 1.4% from last year, but we're still below 7%, 7% lower than the 5-year average on a year-to-date average basis. I've talked a little bit on the Fed basis levels there, that they're trending with the long-term average, and they're up from, like I said there, we were averaging, some weeks there $22 under at the start of the year, which really was pulling on those Fed prices there that you can see during February and the start of March. Projected prices for Alberta Fed steers, again, those are the blue dots there on this chart. They're a little bit showing some weakness there into the fall. So we'll be into those high 130s to the low 140s. There is some room in August for those prices to come back up. There's some feeling there that there might be a little bit of wiggle room in the August contracts. We'll have to see what happens there. But probably not much into September. A lot of it will depend on beef export movement out of the U.S. and then also domestic demand in the U.S. So if we look at Cull Cows here, last week we were averaging just under $85 a hundredweight. Year to date, we're about 5% below where we were in 2018. So the year to date average price is about $87.50 a hundredweight. Seasonally, we should see that Cull Cow market pick up into August. Again, we would see about a 2% increase in price, but and then after August, seasonally that market declines into November, where we see about a 12% decline in price in between August and November. There's some question about whether or not we'll see that bump this year into August, just given the movements that we've seen in late May and June. But there is that potential there, and part of that potential comes from where trim prices are trading right now, and 50% CL trim prices are quite stable and strong. So we may actually see, as we see those number of cull cows, we've already started to see them drop back here, the number that are coming to market drop back here in the first couple of weeks of July. If we see those numbers continue to be tightening up, then we might actually see a bit of support or a bit of a kick up in that cull cow price as they try to bring a few more into market, just given where those trim prices are. As I talked about the basis or the cash-to-cash price difference between us and the U.S. market, last week we were only about $1 over on a 100-weight. This year we've been averaging, a lot of weeks we've been $10, $12 over. So we've really seen that that cash-to-cash basis pull back on our market here. And so for the fall there, I guess I just want to mention this, if we do see those prices, and I'll mention this at the end too, but those estimated prices based on seasonal movements, coming into November, we could see that cow price into the low to mid 70s coming into November if we follow that typical seasonal trend, if we don't see any pickup from that 50 CL market to support prices higher. So if we look at cow movements, this is based off of data here in Alberta. So this is Alberta cow movements, or try to get it as close to just capturing Alberta cow movements as possible. But you can see since 2015, cow movements have been up year over year, and this is just for the first 5 months of the year. So just to compare what's happened up to May 31st, the data for June is still being, hasn't been fully compiled yet, but you can see that for 2019, the only 2 years that we're behind is 2008 and 2010. Those years we had higher movements for the first 5 months. So far we've had just over 148,000 head move. This includes cows that have been exported and cows that have also been slaughtered here in the province. So we're about 3% higher than we were in 2018. Excuse me. For the month of May, we did see a lot of movement there in May. We, based on movements, we had over 26,000 head move, and that was about 25% above the 10-year average. There was a lot of movement in the month of May, and we'll likely also see, once everything's been put together for June, we'll likely also see above average movement for June as well. And then that movement is expected, as we've started to see here in July, to slow down for the summer, and then we'll have to see what happens in the fall as decisions are made at that time. On auction volumes here, you can see that year to date, since the start of the fall run last year, this is starting last September, we have put about 1.4 million head through Alberta auctions. That's down about 5% from a year ago. If we want to look back 1 year, volumes there on the blue line for 27-18 was about 1.6 million head, and that was up over 3% from the previous year. So we've seen those auction volumes continue to go up, which plays well into those higher cull or higher cow movements that we've also seen. And I'll talk a little bit about slaughter here later on, but we've also seen our slaughter numbers are also up in Western Canada as well as Canada as a whole. On feedlot margins, this will be another factor here. You can see that for this is cash to cash margins for a 550 pound steer calf. You can see margins have been negative since early 2018, and those negative margins are going to play as well on the calf price this fall as well, just as we've seen those feed costs rise. And then if we do see that strengthening dollar, we will likely see some pressure on calf prices. For feeders that finished during the month of July here, margins were reported negative across all classes. So we had negative margins ranging from $145 on short keep steers up to $230 on yearling steers. Projected margins for feeders placed in July, just based on where the futures contracts are, those have been calculated, ranging from 124 on a short keep heifer to 245 on a yearling steers. So there is still, margins are still quite negative at the feeding level. So if we look at live exports of Canadian cattle, this is Canadian cattle as a whole. Year to date, this is up till just about to the end of June, or the end of June here for numbers. We've had just over 415,000 head exported. That's up 22% from the same period in 2018. But overall, we're still below the 5-year average, almost 7% below the 5-year average. If we look a little bit closer at the classes here, you can see feeders are up about 8%. Slaughter cattle, and this includes cull cows, is up 34%. Bulls are up about 3.5%, which puts that total up about just over a little over 22%. Part of the reason we saw some numbers moving higher on those slaughter cattle, and that includes the cull cows, is they had winter storms and muddy feedlots down there, so that caused some of ours to be pulled down there, and then also regular contracting that would have finished cattle going south for slaughter. If we look at Western Canadian slaughter here, year to date we're up just under 6%, 5.6%. So far, slaughter's at about 1.29 million head in Western Canada. If we look a little bit closer by sex, we can see that steers are up 6%, heifers are up just under 4%, cows are up 8.5%, and bulls are a relatively small portion, and they're down about 13% year over year. The interesting thing about cows is, they're up 8% year over year, but they're up about 28% compared to the 5-year average. If we compare Western Canada to sort of Canada as a whole, slaughter's up about just under 6% for steers at the Canadian level. Heifers are just over 5%. Cows are up at 6%. And that puts the total slaughter for Canada at 1.66 million head, which is about, again, just about 6% above 2018. To compare that with the US, right now, year-to-date slaughter in the US is at about 15 million head, and that's up just about 2% from a year ago. They've had about 2% fewer steers slaughtered, but heifers are up 8% year over year. Cows are up almost 4%. And that's that transition from expansion to liquidation. The good moisture conditions there this year might slow that a little bit. So we'll see tomorrow when they release those July 1 numbers. But they are entering that liquidation stage where we'll continue to see a few more cows starting to come into the market, and that reduction in retained heifers. On the beef export side, beef exports have been fantastic this year. Year to date, we're at about 1.32 billion by value. That's up 31% year over year. Quantity, we're just over 178,000 metric tons, and that's up 18% year over year. Our top 5 export markets, and this is by quantity. United States is up 23%. Japan is up 88%. We had about a 10% decrease into Hong Kong. Mexico's up 9%, and China is up 300% by value, and about 337% by quantity. So we've seen, China, that 300% sounds quite a big number, but when you look on the chart there, you can see that, so far this year, for the first 5 months, we've shipped about 9,700 metric tons. So it's still a fairly small market. It has grown substantially here in the last little while. So there will be some shuffling of products given what happened at the end of July or the end of June there with the suspension of the issuance of Canadian meat export certificates. So we'll have to see how that plays out on exports to China, but we'll probably see some of those products being redirected to other nearby Asian markets. If you look at Vietnam or Taiwan, Japan, Hong Kong, we could see some of those products going in there and then filtering into the Chinese market. But we'll have to wait and see how that goes. Where the issue might be is on the offal products or byproducts. That could take a little bit more to move those products into other markets. China beef exports were roughly broken down this year into 80% frozen boneless products and about 18% offal products. So that gives some indication of what was going into China. If we look on the import side for what beef has been coming into Canada, this is where I was talking earlier. We've got about a 16% reduction by volume and about 11% reduction by value. So our beef imports from the US are down 16%. From Australia, beef imports are down 29% into Canada. New Zealand is down 24%, and Uruguay is down 20%. So, we've really seen, that increase in production that we have here has been able to go into our market as well as fulfill our increase in exports. And really, drives home that we do have strong domestic and export beef demand here in Canada this year. I want to touch a bit on byproduct values just because of that does make up a portion of the revenue on the packer side, and you can see that byproduct values here have been declining since 2015. If we look kind of at 2014 when byproduct values were up, kind of peaking there, we were averaging about $16 a hundredweight, which added about $216 to a slaughter steer carcass. And then if we look into 2019, we're averaging right now about $11 per hundredweight. So we've lost, and that's averaging about $148 per steer. So that's a decrease of about $68 a head that revenue's been reduced. And so that impact on margin does filter through the supply chain as well, which does also have an effect on live cattle prices. So now on to feed prices here. So this is Lethbridge barley weekly cash price. This chart here, last week they were averaging about $2.90 a metric ton in southern Alberta, and that's down about $11 from the high there. I think that was the week of June 21st that we hit $3.01 a metric ton. So that's a new peak in the cash market for barley. It's about $2 higher than what we saw in May of 2013, and about $31 higher than what we saw in July of 2018. 2008. But you can see overall that barley prices in Alberta have been trending higher, which is in relation to those reduced acreage levels. So we'll see this year as we see we've seen the acreage reports that barley acres are up. So we'll see what impact that has on price. There's been some discussion and some numbers put out there that we could see barley prices down in that $215, $230 range, but there is a lot of time between now and harvest, so we'll have to see how that plays out, and if we do see those barley prices if they do in fact come down that much. What this and if we do have those higher barley production numbers, of course we'll see corn imports reduced, and also that higher price for corn that we've been seeing in the US will also ultimately reduce the amount of corn that comes into Canada as well. On the feed wheat side, you can see that last week we were averaging about $270 a metric ton. That's down about $16 from mid-June when the price peaked there at $286. On the feed wheat side, that's not the highest price we've seen. As you can see, 2012 we were at $310. And in April of 2008, we were at $330 a metric ton for wheat. And following barley prices, we are also expecting feed wheat prices to move lower. And then the other play in there will, depending on how the rest of the growing season goes, but we're already hearing talk that there could be increased silage, and then other crops being put into feed just based on how the season's affected those crops. On the forage side here, this is an average price for Alberta farm gate hay. I use this chart more as an indication of trend in prices. I have put this chart up in the past, and I've been questioned on where I can find hay at this price. I don't have an answer for that, but this is just sort of an overall provincial average of hay prices that's collected. So for 2019 right now, we're averaging over 8 cents a pound at about 8.3% or 8.3 cents per pound. But that price, even at that price, we're up close to 17% over 2018, and when you compare that to the 5-year average, we're pushing 47% higher than the 5-year average. So we have seen those, since about 2016, we've continually see those forage prices increase year over year. Now, if we take a closer look sort of at alfalfa hay, this is data out of AFSC. And you can see here, this is on a regional basis, tries to give more of a regional indication of what's happening out there. This is the average of the first and second cut alfalfa hay. This only goes up till the end of Q1 2019. The quarterly data for the second quarter, Q2 data has not been released yet. But you can see here in the north, they're averaging just under 8 cents a pound, and then up close to that 11.5 cents a pound in the central and southern regions of Alberta. Barley versus corn. I just wanted to show this plays into feeding advantage, disadvantage between Alberta, US. So you can see that barley prices right here in the black circle there at the end, we've started to see those barley prices come down, but we're continuing to see that corn price creep up, which is really narrowing that feeding disadvantage that we're seeing right now. Year over year, we've seen that barley prices in Alberta have jumped about 19%, but we've only seen about a 7% increase in corn prices for the same period. And as we start to see, as we continue to see that price differential, if we continue to see corn go up and barley does in fact continue to come down, we'll see that differential reduce, which might actually put us into a feeding advantage here compared to the US if barley prices go lower than corn. So all this plays into, the estimated or average winter feeding cost for a cow, the carrying cost for a cow. So this data here is based off of Agri-Profits data, data that's collected through the Agri-Profits program. So you can see this data goes from 1995 to 2016. After 2016, I've done estimates and forecasts based on an average margin an average ration, not an average margin, but an average ration to feed a cow for 175 days. So you can see that, we had a little bit of pullback there in 2017. 2018, I estimated winter feeding costs at about $4.50. That does include straw for bedding. In talking with some producers, they said that cost was pretty reasonable, if not a little bit light. They were expecting to see costs at about around 500 or maybe a bit more. This year, these numbers right now are based on data that was collected during, or prices that I collected during June and into the first part of July to kind of come up with this forecasted cost right now. And of course, there's a lot of room in here as prices, if they do come down going into the fall. But right now, that cost is around that $5.40 per head. And hopefully we do see that cost come down. But right now, given the current market for hay and barley, that's where that cost is sitting, is around $5.40, and that does include the bedding as well for the animal. So this is just a breakdown on a chart of the costs that go into that was used in those estimates. So you can see winter feed and bedding has been increasing pretty much continually. 2012 we were at $277. Now we're at, in 2016 for this chart here, we were at $409. And basically what I wanted to do here is take these numbers and just show the breakdown on average. So you can see that feed and bedding costs average about 43% of the benchmark for a cow-calf operation. Pasture costs are about 25%, labor is about 8%, and then other variable costs are about 15%, and fixed costs are about 10%. So this just gives an indication of where decisions or where cost increases can really impact decisions and affect the operation, the operation or the financial standing of the operation. So looking ahead here for what do we see into the fall? So I talked about fed steer, they were averaging that about 144 last week. Moving into the fall, we'll probably see based off the futures contract and where average basis levels, and then looking into that mid 130 to the low 40s. There's a little bit of room there, as I mentioned, potentially in that nearby live contract to go up about possibly $5, but we'll have to see how beef demand plays out in there. If we look on the Cull Cows side there, we can see that we were averaging $85 per hundredweight last week, and I've got that number into the mid 70s for going into the fall, and that's based off of that typical seasonal decline that we would see going into the fall in the cull cow market. Now there is some room there based on what I said before about strength in the trim market and the potential for that to maybe pull those cow prices up a bit and support them a bit higher. And then also depends on how many cows we see continuing to come to market and then moving in the fall as well. Yearling steer side, we were at 173 last week. Right now, based on where the futures are and average basis levels, we see those prices in that the high 170 to the low 180s. And there's going to be some play here in all these numbers based on if we do continue to see that dollar strengthen, and then also if we see some change in the basis levels. On the steer calf side, we were at 209 last week. Right now, numbers based on where feed costs are to feed those animals out to a slaughter weight, puts that number as low, even into the low 190s or just over into the 200 mark there. So there is going to be some weakness there based on those higher feed costs. And then also if we see that dollar continue to strengthen, that will also have an effect on pressure on the steer calf market as well. So if we look at some of the other market influencers, I've talked about the strengthening Canadian dollar. US expansion appears to be wrapping up, and we're going to see that move into a liquidation phase. We've got ongoing consolidation in the Canadian herd and maybe even a bit of liquidation here, just based on what's been happening this year with moisture conditions. I didn't really talk too much or at all about hogs, but African swine fever continues to move through China, Belgium, Poland, Vietnam. It's into a few other Asian countries as well, and that's taking a big bite out of pork production, and that we should see at some point a potential boost into beef markets and beef exports. But the question is when that will come. A lot of those hogs that have been slaughtered, that pork has been put into cold storage, so there still is some buffer there on large volumes of cold storage, especially when you look at the Chinese market, and that just sort of helps to shore up supplies for the short term. We've got red meat and poultry production up here in North America. We've got a lot of trade uncertainty. That's just everywhere. Of course, that ongoing volatility in the futures market. Then we've got some new competing products, the Beyond Meat and some of those other plant-based products that appear to be getting some traction in the consumer market. And of course, some concerns about the global economy, especially moving into the second half of 2019. So I just wanted to finish this off and just list some of the other resources that are available here. Of course, we've got the Ag Info Center, the Do More Agricultural Foundation. The website is there. Farm Safety, HealthLink Alberta, our partners in Saskatchewan through the Ag Knowledge Center, got the Farm Stress Line, and of course BCRC. They have a lot of good information on their website as well. And then I'd also like to thank our partners listed here. And as we continue to go through this series, we'll continue to work with these partners. So that wraps this up. So we've got time for questions now, I think.
Thanks, Jason. We don't have any questions in the queue here. So if for those attendees, if you'd like to ask a question, just reminder to type the question into the question box, and we'll get them answered by either Ted or Jason. So I'll get Ted, both of them back online here. Any further thoughts or comments that while we're waiting for questions about what you're seeing out there? Just general comments more than anything else.
Well, I'm just talking about forage prices again, and I've said for years that hay prices, forage prices don't settle out until about October. By that time, we have a pretty good idea of what kind of production went in, both quality and quantity, whether some of their cereal crops came off as salvage, silage, something like that. That definitely impacts on the hay price, forage price. By October, we have a pretty good idea of too whether calves are going to be backgrounded, and if they're going to be backgrounded, that usually puts more demand on hay. If they're going into the feedlot, of course, that's going to reduce the hay demand. And by October, hopefully, we have a pretty good idea of what kind of winter we're going to go into, and you know, that has a big bearing on feed disappearance.
Good. Thanks, Ted. Any other comments you want to add, Jason? While we wait for some questions.
No, I think Ted covered everything there. You know, just based on where, you know, how things play out here over the next few months on the feed cost thing. I guess the only other thing I didn't touch on was transportation costs, and I know last year, you know, there was reports of hay, you know, the cost to move hay at, you know, $6.50, $7.50 a loaded mile. So that's another big factor that could play on there, depending on, you know, depending on where production ends up this year for hay, and then also for other feedstocks as well.
Okay, thanks. Well, there was a lot of information there. I think it's going to take some things to digest for people on the line, and probably other people who are going to listen later. So, you know, if you've got any further questions, you know, and things come up, by all means, contact Ted at the Ag Info Center. Jason's numbers and email is right there. So, you know, if you got any questions, I'm pretty sure that they're available. So seeing as we don't have any questions coming down the pipe here, so we'll close it out. I'll just let you know that, like I said, this is being recorded, so you can listen to it at your convenience. You'll get an email with a link in tomorrow. Also, there is a survey at the coming on as soon as we close this webinar. So please take the time and give us your feedback, and in addition, any other topics that you want to hear in down the road. So our next webinar is August 1st, same time, 7:30 at night. And the next topic is going to be working with your cropping neighbors. We're going to talk about salvage crops, pros and cons. So with that, I'm going to close out the webinar. And I'd like to thank everybody for taking the time tonight, especially Jason and Ted. Thanks very much, everyone, and have a good evening.